Hi, welcome to session 49 on liquidation under IBC. Let's quickly recap what we have understood and discussed in the previous session. But today's session we will focus on IBBI regulations. So in the previous session, we have understood the process overview of the entire liquidation and the timelines given under various regulations of the IBBI as well as the provisions of the Act. Let's quickly move forward today to the regulations. Just to quickly recall, these regulations are called as Insolvency and Bankruptcy Board of India, Liquidation Process Regulations 2016, right? The first and the second regulation always talk about only the applicability, scope and the definitions of various words that are used within the provisions. We are not getting into those regulations. We are coming into the straight away the conceptually important regulations. So first of those, which is regulation 3, deals with appointment of the liquidator. If you want to understand the relation between the Act and the IBBI regulations, section 34 of the Act talks about appointment of a liquidator and regulation 3 of the regulations talk about appointment of the regulator. And what does they say? The liquidator and their insolvency professional entity must be independent of the corporate debtor. This is the first requirement. What does it mean? It means that a person who is entrusted financially in the corporate debtor or who is related to the promoters of the corporate debtor or who has a conflict of interest with the corporate debtor, then such person shall not be appointed as a liquidator. At the same time, a liquidator sometimes maybe is a part of an insolvency professional entity. For those who are not aware of an insolvency professional entity, IBBI allows insolvency professionals to group together and work as one single entity, and this can be an LLP or a private company formed under IBC, which will be called as an insolvency professional entity, which will comprise of a group of insolvency professionals. However, as far as appointment is concerned, appointment cannot be of the entity. Appointment shall always be of the individual. I'm sure you're understanding. So, I am an individual, I am appointed as a liquidator in a certain case, but I am also part of an insolvency professional entity. And one of the partners in that entity is actually directly interested in a corporate debtor. Then will I be qualified or eligible to be appointed as a liquidator of the same corporate debtor? No, because my partner who's in partnership with me in the insolvency professional entity has a direct interest in a corporate debtor, and because of that my independence in the corporate debtor is absolutely affected, and therefore I now cannot be a liquidator for this corporate debtor. Now look at the second paragraph here. The liquidator must promptly disclose any personal or financial relationship with the corporate debtor or its stakeholders to the board and adjudicatory authority. The moment I am saying board here, it is IBBI and adjudicatory authorities NCLT. Now the point is, if you have an interest, are you disqualified just because you have an interest? No, here what we are saying is, to the extent possible, the liquidator must be an independent agency. But wherever before or after appointment as a liquidator, if the person has acquired any interest within the corporate debtor, then he must promptly notify the liquidator as well as IBBI. I mean adjudicatory authority and the IBBI. Now, the choice to continue you as a liquidator or not is with the adjudicatory authority. But our duty as resolution professionals or liquidators is to inform the concerned that I have an interest. After that, the decision rests with the adjudicatory authority. This is regulation 3. Now in the same regulation 3, there is one more important line which says liquidator cannot continue if their insolvency professional entity or any of its partners, directors represent another stakeholder in the same liquidation process. Let's say I am the liquidator who's actually doing the liquidation process. I am partner of a professional entity and my partner, Mr. X, in this professional entity is actually representing corporate debtor and its promoters, which is completely conflicting with my interests as a liquidator. Hence, I am now ineligible to become a liquidator because my partner from this IPE is representing a party which has a conflicting interest with me as a liquidator. Then, moving forward, we come to regulation 4, which talks about liquidator's fees. The liquidator is entitled to receive a fee for their services, which is a percentage of the realization from the liquidation process. Some of you who are wondering as to what kind of financial emoluments can flow out of this kind of assignments, you must be thinking there is so much of a responsibility, so much of a risk, so much of pressure because the entire process is time bound. What will I get out of this whole process? If you are an insolvency professional, you will know that liquidators and resolution professionals who are qualified IPs sometimes have a tremendous opportunity to make money. If you look at regulation 4 itself, what is it saying? It's saying that liquidator is entitled to receive a certain percentage of the realization from the liquidation process. The liquidator is entitled to receive a fee for their services, which is a percentage of realization from the liquidation process. Let's go to next slide. Here, the fee is paid in stages as the assets are realized, subject to the approval by creditors committee or the adjudicatory authority or the stakeholders committee. The liquidator is also entitled to receive reimbursement from other expenses incurred while carrying out liquidation duties. So moving forward, there is also another point in regulation 4 which says the fee is paid in stages as the assets are realized, subject to the approval by the stakeholders committee or the adjudicating authority. The liquidator is also entitled to receive reimbursement for any other expenses incurred while carrying out liquidation duties. Like we said, you can always engage experts. You can also engage registered valuers for carrying out the duties as liquidator. While you carry out these duties, you will incur a lot of expenditure. Are you entitled to receive this expenditure? Yes. This is called as reimbursement of liquidation costs incurred by the liquidator shall be reimbursed. Remember, this is over and above the money that you get as percentage on the realization of assets. That's a liquidator's fees. And what we are talking about here is reimbursement of the expenses. Now, when I was talking about money, I didn't deliberately tell you the figures. Now look at the amount of money that the liquidators can make. If the realized value of the asset is rupees 1 crore, then liquidator can get a 6% fees from that entire realized value. Now when you look at 1 crore and you're computing 6%, it is 6 lakhs rupees. So we all might think that 6 lakhs is not a big deal, it's fine, everybody makes it. But look at it, as you keep on going forward and as the realization amount increases, Though the percentage is decreasing here, but the amount of money that the liquidator is making is phenomenal. I'll take you straight to fourth row in the table where the realization value is 50 crores and the percentage fee charged by the liquidator is 3% of the amount exceeding 50 crore in addition to the fee on the previous slabs. That is, up to 50 crore he is going to get 4% and anything above that he is going to get 3%. But here if you look at the first 1 crore, it is only 6%. And after the first 1 crore, he is going to get 5% up to 10 crore. After the 10 crore up to 50 crore, he is going to get 4%. So let's look at realizable value. If I am saying the value of an asset is 50 crore, he gets 6 lakhs on the first 1 crore. He gets 5% of the balance 9 crores here. 9 crores into 5% is about 45 lakhs plus the first 6 lakhs, that is 50 lakhs already. Then from 10 crore to the 50 crore, on the 40 lakh surplus is going to get 4%, 40 crores I mean. 40 crores into 4% is already 1.6 crores plus 40 lakhs here. That makes it 2 crores plus few more percentage here. So remember, if I am selling an asset for a 50 crore rupees as a liquidator, I am entitled to get 2 crores. So 2 crores is not a very small amount. That's why I'm just telling you, as the realization value keeps on increasing, though the percentage that he can get keeps falling, but the ultimate chunk of money that he is going to get will be huge. Therefore, now the insolvency professionals, professional occupancy or career is substantially changing, and then a lot of people might choose and make money. But however, remember one thing, it doesn't look as complicated. When you look at the table here, you think that okay, you sell, you make money, you sell, you make money. But it is not as simple as that. To actually sell an asset at a certain value, it takes a phenomenal effort from the liquidator, right? So the amount of money that you're going to receive will be commensurate with actual effort that you're putting in selling that asset. That's why this kind of a fee is prescribed for the liquidator. So now, after understanding the fees for the liquidator, we will move forward to understand the reporting requirements under the IBC. You can see there are 6 blocks here. Number 1, firstly, we are expecting a very preliminary report to be given by the liquidator as soon as he receives claims from the claimants. And after that, the moment he is actually appointed as a liquidator, he receives claims and he forms a liquidation estate, he then will make an asset memorandum as to what assets have been identified, what assets are forming part of his estate and what are not forming part of his estate. And after that, every now and then he is going to file progress report. This is an important provision. Then after that, when he is selling the assets of the corporate debtor, he is also going to give sale report to the adjudicating authority and also to various other stakeholders. And after that, minutes of the stakeholders' consultations will also be reported to the adjudicating authority as to what suggestions have been given by the stakeholders in terms of the consultation. Then lastly, a final report is given after these assets have been realized and the proceeds have been distributed. So only post the final report, it is a fit case for dissolution. Let's move forward to understand other aspects. So we have covered Regulation 3, we have covered Regulation 4, and we are now covering Regulation 5. It says that the liquidator must preserve both physical and electronic copies of the reports and minutes for 8 years after the corporate debtor's dissolution. A stakeholder can request the reports and minutes by submitting a written application and pay the associated costs. Remember, this is an important provision. Let's say after the company is being dissolved, 3 years later, one of the stakeholders comes and says, I didn't understand exactly how did you actually distribute the sale proceeds. I want to have minutes of those meetings, and I want to see the copies of various accounting entries that you maintained. Then the liquidator is bound to reply to such person with the necessary papers and documents within the stipulated time. And therefore he is bound to maintain all these copies with him for a period of 8 years, after which he can weed out, destroy these documents because they are no more relevant. This ensures that all relevant reports are prepared, preserved, and made available to stakeholders, promoting transparency and accountability in the liquidation process. Hence, reporting is very critical. Let's come to Regulation 6 that talks about registers and books of accounts. So as a liquidator, when a person is handling tremendously valuable liquidation asset and there is so much of money involved, it is very, very important to maintain certain books of accounts and registers so that transparency is ensured throughout the process and is later on not questioned, or his actions will lead to criminal negligence. Therefore, it is important to maintain the books of accounts and also certain registers. So what is Regulation 6 saying? If the corporate debtor's books are incomplete at the liquidation commencement date, the liquidator must complete and update them quickly after the liquidation order is passed. Why? Because now it is your duty as a liquidator to maintain the corporate debtor's books of accounts. You cannot blame your predecessor, or you cannot blame corporate debtor for not maintaining its books of accounts. Now it is your absolute responsibility. The liquidator must maintain specific registers and books related to the liquidation, preserving them for 8 years from the corporate debtor's dissolution. This is what we have covered earlier. The registers and books can follow the format in Schedule 3. This is an important thing. We remember that whatever formats, contents which cannot be brought into the core law, that is IBC and its sections, if you cannot insert a certain aspect into that, you will obviously have schedules made out which will define certain formats and forms, and those schedules will be placed at the end of the entire act. So there are many schedules under IBC, and Schedule 3 deals with the books of accounts to be maintained by the liquidator during the process of liquidation. The liquidator shall keep receipts for payments made or expenses incurred by him. Appointment of professionals. Liquidator can hire professionals according to Regulation 7. As I told you before also, wherever liquidator is actually not competent to take certain decisions, or it doesn't have knowledge of certain things, he can obviously have professionals engaged to perform certain duties to give him inputs and information on what he wants. Like currently I am handling a case as a professional where we are asked to dig deep into the financial transactions of a corporate debtor and a personal guarantor, and to understand whether there are any preferential extortionate transactions that have happened. Now, as an insolvency professional and a qualified company secretary, though I have financial knowledge, I may not have the necessary equipment and necessary tools with me which will enable me to perform this audit trail. Therefore, what we are doing is we are hiring professionals, detective agencies which will perform this task and give us a report on where they have found these extortionate, preferential or undervalued or fraudulent transactions. Now I will have to pay a lot of money to these agencies, and this will be part of the liquidation cost, and I will be actually reimbursed for the cost involved by the proceeds. Appointed professionals must disclose to the liquidator any personal or financial relationship with the stakeholders or the debtors immediately. After that, wherever I have certain consultations to be made with the stakeholders, I can actually consult them on various aspects as to what and how it to be done, and the liquidator must maintain details of these consultations with the stakeholders as specified in Form A of the Schedule 2. But if we recall, we remember that one particular line: are the consultations with the stakeholders binding on the liquidator? Should he follow these advices? No. These are non-binding consultations, and hence liquidator may take his own decisions, though he has consulted the stakeholders and taken their opinions. This brings us to the end of session 49, and we are trying to understand the summary as to what we have done in the past few minutes. We have covered Regulation 3 to Regulation 8 of IBBI, liquidation process regulations, and there we have seen that the appointment of liquidator, what is the eligibility criteria, and what happens if there is a conflict of interest. We've also seen that liquidator's fees is important. We've seen that there are slabs. First 1 crore will have a 6% fees to be paid to the liquidator on the realized value of the assets. After that, there is a 5% fees, and after that there is a 4% fees, and finally there is 3% fees on anything realized above 50 crores. This is liquidator's fee structure. After that, Regulation 5, we have seen a lot of reports to be generated, like preliminary report, final report, report on the sale of assets, etc. After that, we have seen Regulation 6 that talks about registers, books of accounts to be maintained under Schedule 3 for a period of 8 years. After that, we said the liquidator can appoint various professionals under Regulation 7, and the fees paid to the professionals will form part of the liquidation cost. And lastly, we said you should also have consultation with the stakeholders and record those consultations within the minutes and maintain those minutes for a period of 8 years in Form A mentioned in Schedule 2 of the Act. So this brings us to the end of session 49, where we have understood the IBBI regulations ranging from 3 to 8. In the next session, we will cover more regulations. Thank you.